Imagine this. The same financial genius who foresaw the 2008 housing bubble collapse is now clashing with Nvidia, the powerhouse behind artificial intelligence, and he's not backing down. Even as the company strikes back, this gripping standoff between Michael Burry and Nvidia is heating up, and it's got everyone in the investing world talking. But here's where it gets controversial. Is Burry's pointed critique justified? Or is Nvidia just doing what any major corporation does to defend its turf? Let's dive into the details and break it all down in a way that's easy to follow, even if you're new to the stock market scene. First off, for those who might not know, Michael Burry is a legendary figure in finance. He shot to fame back in 2008 when he correctly predicted the subprime mortgage crisis, famously betting against the housing market through his fund and even inspiring the movie The Big Short. So, when this expert speaks out, people listen. Last week, Burry took to X, formerly Twitter, to voice his concerns about Nvidia Corporation, the leading player in AI technology. Specifically, he highlighted issues with the company's stock-based compensation dilution and its reliance on stock buybacks. To clarify for beginners, stock-based compensation means Nvidia rewards its employees with company shares or options, which can dilute or water down the value of existing shares by increasing the total number available. Stock buybacks, on the other hand, are when a company repurchases its own shares to boost stock prices and shareholder value. Burry argued these practices could be problematic for long-term investors, potentially masking underlying weaknesses in Nvidia's financial health. But here's the part most people miss. Nvidia isn't taking this lying down. According to a recent Barron's report, the company fired back over the weekend by distributing a memo directly to Wall Street analysts. This memo aimed to address Burry's claims head-on, providing what Nvidia sees as counter-evidence to defend its strategies. It's a classic corporate response. Push back on criticism to reassure investors and analysts that everything is above board. And this is where the controversy really ramps up. On one side, Burry's supporters might see him as a vigilant truth-teller, protecting everyday investors from potential pitfalls, much like he did with the housing market. On the other hand, critics could argue that Nvidia's buybacks and compensation plans are standard practices in tech, helping attract top talent and stabilize stock performance. Is Burry's skepticism a sign of real insight, or is he just stirring the pot against a company that's been a Wall Street darling lately? To expand on this a bit, let's think about a simple example. Imagine you're running a lemonade stand, and you decide to give your helpers extra cups of lemonade as bonuses. That's like stock-based compensation. It might mean less profit per cup for you later. Then you buy back some of your own lemonade recipe cards to make it seem like your stand is more valuable. Stock buybacks. It could work for a while, but if the core business, making great lemonade, isn't solid, problems might emerge. Burry seems to be suggesting Nvidia might be in a similar boat, prioritizing short-term boosts over sustainable growth. Nvidia, of course, disagrees, likely pointing to its booming AI-driven successes as proof that these strategies are paying off. This back and forth raises bigger questions about corporate accountability in the fast-paced world of tech investing. Should investors trust contrarian voices like Burry's, or lean on official company statements? And what does this mean for Nvidia's stock and the broader market? It's a debate that's far from settled. What do you think? Is Michael Burry onto something here, or is Nvidia right to push back? Do you agree with his take on stock dilution and buybacks, or see them as smart business moves? Share your thoughts in the comments below. I'd love to hear your side and spark some discussion.